This is Macro Horizons, episode 289, Labor Day Blues, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of September 3rd. And as we fire up the grill one more time this summer, we'll note that you can't put a price on spending time with friends and family. Hence, there's no inflation. Just don't look at the cost of steaks. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market had very little fundamental information from which to derive trading direction. Now, that certainly didn't mean that there weren't a few choppy episodes. The fact of the matter is, however, that prices were largely contained within a defined range. And while we did see tails of the 5- and 7-year auctions, the reality was that they were very modest, and the more interesting auction outcome came in the form of the 2-year. Now, it was the final 2-year before the Fed starts cutting rates, and so it followed intuitively that investors would utilize the liquidity provided by the event. The modest stop-through was accompanied by above-average non-dealer awards, which also contributed to the curve steepening bias. While 2s 10s didn't make it back to positive territory, it was easily within striking distance. And what's important about this isn't the fact that we're close to zero in this benchmark spread, but rather that the move has been orderly and it wasn't accompanied by the flight to quality character that brought 2s 10s back into positive territory at the beginning of August. The other notable data event was what didn't occur with initial jobless claims. The consensus expectation was for a 232,000 print. We got 231,000, and the market was content to focus on the lack of an upside surprise, thereby clearing the path for yields to drift a bit higher. Now again, all within the confines of the prevailing range, and therefore there wasn't any relevant technical levels triggered. There were upward revisions to real GDP, which brought the second quarter to 3.0% versus the 2.8 previous estimate. Now, all of this occurred with a downward revision to core PCE during Q2, coming in just a tenth lower than the prior estimate. It's worth noting in this context that the week just past also contained softer inflation data from Germany as well as Spain, providing some justification for the ECB's decision to cut recently, with expectations of more to come. We highlight this because the divergence between most other major central banks, with the exception of Japan, in rate-cutting mode already, from the Fed, who has delayed rate cuts until next month, has been a focal point for many investors, and the fact that we're finally seeing the Fed come in line with the other major central banks reduces some of the uncertainty for global fixed income, and if anything, simply reinforces the sentiment that favors duration, and therefore we expect that dip buying will continue to be the norm, especially further out the curve in 10s and 30s, as we're shifting into a global rate cutting environment as opposed to the hiking environment seen throughout much of the last 2 years.
Well, Ian, it was the last week of August, and frankly, the Treasury market behaved as such. We did get some data of note, GDP revisions, initial jobless claims, and a fairly uneventful round of Treasury supply that left the market well within its current trading range, and heading into the unofficial end of summer and in preparation for this cycle's first rate cut, at a decidedly lower yield level than many thought was going to be the case as recently as just a few months ago. But if there's been any lessons learned over the course of summer 2024, it's that there are still plenty of buyers of treasuries out there, both domestically and abroad.
And to be fair, it was the last 2-year auction supply before the Fed starts cutting rates. And so it followed intuitively that the front end takedown was solid, certainly when we looked at non-dealer awards. It's also notable that there was a reasonably big roll between the when-issued 2-year note and the current 2-year note, roughly about 4 basis points. So as the new note became the on the run, we saw the yield curve steepen out further, with 2s, 10s reaching negative 3 basis points, give or take. Now, one of the reasons that we're characterizing this particular price action in the yield curve as different from the knee-jerk steepening in the wake of the most recent payrolls print is the fact that the current move has been more gradual, which implies stability, but it has also occurred as some of the more dramatic Fed cut assumptions for this year have been taken off the table. Recall that early in August, the global sell-off of equities was accompanied by market chatter regarding the potential for an emergency rate cut. While we were never in the emergency rate cut camp, it nonetheless drove a lot of the front-end price action during the first full week of August. Fast forward to early September, and the market is reasonably confident that the Fed will cut at every meeting between now and the end of the year, with an extra 25 basis points priced in at one of the 3 meetings. So translating that through to our take on the sustainability of the steepening of the curve, this slow, methodical, fundamentally driven move that has got us back close to zero in 2s, 10s will have a lot more staying power than any knee-jerk flight to quality.
And part of that move also has to do with what we heard from Powell last week at Jackson Hole. The chair didn't really offer much in the way of forward guidance about the path for Fed funds from here, and really our takeaway from the Jackson Hole Symposium was that the Fed is viewing the mission against inflation as largely accomplished, and again formally acknowledged their concern on the labor market has reached a point when any further weakness would be an unwelcome development. Now, there was little doubt in the Treasury market even before Powell's speech that the Fed was preparing to begin the cutting campaign in September, but the fact that Powell didn't close the door to the potential for a larger move, as you touched on, Ian, and firmly entrenched this idea that whereas earlier in this cycle, inflation was unquestionably priority number 1 in the dual mandate, now supporting the labor market receives that designation. What this means is that looking out over the balance of this year and into 2025, whereas when inflation was surging, the bias would be toward an inflection higher in very front-end rates. Now Powell, and the Fed more broadly, has emboldened the reaction function of the asymmetry around rates moving lower going forward. And so in practical terms, what that means in terms of trading treasuries is a more robust dip buying bias, especially in the front end of the curve, and a more aggressive willingness to add steepeners, which will contribute to what we started the conversation with, and that is the slow grinding move steeper that will ultimately get 2s, 10s back to positive territory, as each incremental piece of data that further adds skepticism to the soft landing narrative will drive further front-end outperformance.
It's also worth noting that as the data comes in and allows investors to further refine expectations for both the Fed and the real economy, we are also moving into an interesting point of the year from a timeline perspective. We're working through the typically constructive seasonal patterns in treasuries with yields biased a little bit lower towards the end of the summer, only to trade a range between now and the end of the year. That remains our core operating assumption, and we do not anticipate a massive repricing between now and the end of the year, and we're holding our year-end forecast for 10-year yields in a range of 375 to 395. Now, the logic here is relatively straightforward. The most bond bullish period tends to be the run-up to the first rate cut. And on September 18th, not only will we have the cycle's first cut, but we'll also have an update of the SEP and the beloved dot plot. That will be the perfect opportunity for monetary policymakers to clearly signal whether they're going to cut at November and December or just in December. More important will be the 2025 dot. If it continues to signal 100 basis points worth of rate cuts, the market will intuitively translate that into 25 basis points per quarter. So with that policy backdrop, it's difficult for us to envision 10-year yields dropping materially below 350, But at the same time, we're also challenged to make a case for four-handle tens, especially as Powell is starting the journey to bring Fed funds back to at least neutral, which, for argument's sake, will take the Fed's lead and call that 275.
And there's another important dynamic that's going to frame the price action over the balance of this year and into 2025 that's related to, although not explicitly a function of the election in November, and that is the growing deficit and size of Treasury issuance, with what that means for term premium in the longer end of the curve, the outright level of rates, and the overall shape of the Treasury curve. Remember last year at the August refunding announcement when the larger than expected auction size increases inspired that bear steepening push that ultimately gave way to the Treasury Department first increasing coupon auction sizes by less than expected, and then ultimately bringing us to the current issuance paradigm where we know that the Treasury sees itself as well positioned to fund the deficit for the next several quarters. And in our discussions with clients around the impact of the election and what it means for the overall borrowing needs from the Treasury Department, regardless of the administration, we're of the opinion that whether it's a Trump White House or a Harris one, lofty government spending is going to be a feature of the policy agenda. And so in terms of the actual difference for what it means in terms of Treasury borrowing needs, we're not sure there's really all that much difference to consider in terms of fiscal borrowing. Now, that doesn't mean there aren't growth and inflationary implications from government support for the real economy, but as it relates specifically to issuance, auction performance lately and the overall level of rates demonstrate that supply indigestion has been put on the back burner for the time being.
There's also another implication from a pro-growth policy from the administration, as well as the Fed cutting rates, which is implicitly pro-growth as well. And that is, if the Fed is able to prevent a more material downturn in the real economy, then one should assume that tax receipts will be stable, if not improving, in 2025, which will further reduce the potential need for Treasury borrowing to increase in the latter part of the year. Now, ultimately, we don't think that this will dictate the outright level of yields. Instead, 10 and 30-year yields will remain a function of global growth and inflation expectations, and as the Fed has been successful in reestablishing price stability, even if one looks at the risks of inflation as skewed toward the upside as opposed to the downside as we move into the next phase of the cycle, the potential range of upside surprises will be limited. After all, the Fed has demonstrated its willingness and ability to contain realized inflation.
And looking ahead, the start of September's highlight will be August payrolls data, and we would argue the first potentially trend-setting piece of data as the market heads into the fourth quarter. And if we needed any reminder of the relevance of the jobs market to the current market dynamic, one need look no further than the BLS's revisions to overall job growth we got last week, and the market's response to Thursday's data this past week, where a downward revision to quarterly core PCE was effectively ignored in favor of what was a nothing if not expected jobless claims print, 231,000 initial filers versus the 232 that was anticipated, another week that didn't show climbing numbers of those filing for unemployment insurance, and another week of the paradigm that a still strong jobs market is intact. The fact that lower inflation data actually netted to higher Treasury yields is a relevant indicator of exactly what we heard from Powell at Jackson Hole. Progress on bringing inflation back toward 2% has been sufficient to now begin worrying about the labor market and to now start focusing more on the labor market data. So in terms of tradability, that means larger responses to the jobs numbers, both jobless claims and payrolls, and probably a bit more muted reactions to CPI, PPI, and PCE as the relative importance of the drivers of the macro narrative have shifted increasingly away from inflation and toward hiring.
And it's also notable that as the market's attention shifts decidedly in favor of the jobs data, we've seen a de-emphasis of some of the geopolitical tensions that continue to dominate the headlines. It has been very surprising that the market, to a large extent, has offered comparatively tame responses to escalations of tension in the Middle East. Now, clearly, the contained price response in commodities markets has aided in this dynamic, but nonetheless, this is something that we will keep on the radar over the course of the next several weeks as a potential market mover.
And on the topic of things not moving, can't wait for Labor Day traffic.
I hope there's a supercharger. In the holiday-shortened week ahead, the Treasury market will have effectively one key data point that will define the next several weeks of trading. That comes in the form of non-farm payrolls and the updated unemployment rate. The market is looking for a relatively benign print for headline payrolls of roughly 180,000, but the more interesting aspect of it will be what happens to the unemployment rate. Recall that there's a meaningful difference between the establishment survey, which is where headline payrolls is derived, and the household survey, which gives us the unemployment rate. Now, at present, the market forecast for the unemployment rate is for a 0.1% decline. This provides a bit of an offset to the fact that the Somm rule was recently triggered, although as a recession indicator, the market seems less worried about the Somm rule per se and more concerned that any follow-through toward a weaker employment landscape would prompt the Fed to err on the side of cutting more by the end of the year. This is why the market is so focused on the employment data for August. In fact, the market's focus has finally shifted from being solely on the inflationary environment to being almost exclusively at this point focused on anything related to jobs. Now, as a result, we ultimately expect that the core inflation figures for August will be de-emphasized as it relates to the Fed's thinking at the September 18th FOMC meeting, as well as how that's factored into the SCP and the beloved dot plot. The dot plot will provide the Fed an ideal opportunity to clearly signal to market participants whether they're going to cut at the November and December meeting or simply at the November meeting. Now, this would be done via the 2024 dot, being either 25 or 50 basis points lower. Now, the Fed certainly isn't in the habit of pre-committing to any specific moves in the policy rate, although the proximity to the final two meetings of the year would imply a higher degree of accuracy in the dot plot, if nothing else. Our steepening bias remains solidly intact, and we expect that any weakness via the jobs data, whether it's the anecdotes or the BLS release itself, will ultimately translate into a more significant bid for the two-year sector, which will exaggerate the steepening bias that is already in place. In fact, we anticipate that by the time the proverbial dust has settled on the non-farm payrolls report, that 2s10s will be back comfortably into positive territory, and the prevailing momentum will have allowed this move to occur in a more sustainable fashion than if we had simply seen the repricing as a function of a flight to quality. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And we'll sign off with a nod to our good friends at SIFMA. Once again, you got this one right. See you on Tuesday. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.